What you can learn from historical stock market returns. All right, so I get this email from my man, Med Faber. He doesn't give it to me personally, but I subscribe to Med Faber and his email, and he's using this Crespont research. And if memory serves, Ed Easterling is the guy who writes for Crespont Research, and Ed Easterling had a great book I read, man, going on 15 years now. Oh, now Finney's barking. The minute I start doing a video, someone interrupts. Hold on. The book was called Improbable Outcomes or something like that. I remember we had went back to Phoenix for the first time since we moved there in 2001, moved from there in 2001, in 2011. So we hadn't been back in 10 years. And we rented a place off Squaw Peak Parkway, just a little La Casita kind of place over Easter. It was fun. We had a good time, the whole family and everything. And I'm reading this book, and Ed Easterling was using the CAPE ratios, cyclically adjusted PE ratios. And Finnegan, come here. Hold on a second. What would I do without these dogs interrupting me? And there's no Pablo. Where is Pablo? Oh, boy. Anyway, so Ed Easterling had written this book on probable outcomes and using the CAPE ratio, which is Bob Shiller's thing from Yale. There he is. Oh, boy. Hi. You got ants in your pants, buddy. Just relax. Come here. And I remember, I wouldn't say Ed Easterling was negative on the markets, but the way, I'm not saying he said explicitly the markets are overpriced and whatnot, but I mean, all the people back then using CAPE were saying the markets were overvalued. Come here. Come on. Come say hi. Come on. Come up. Come say hi to everybody. No? You don't want to say hi to everybody? You want to come up? Oh, there he is. Look, there he is. Oh, there's a baby. There he is. Good boy. Love that dog. He's such a knucklehead. He's such a knucklehead, but we love him so much, don't we? Yes, we do. You're a good boy. He's got a wet nose. He just wants to play. He's like a puppy. He's 4 years old, but he's still like a puppy. And then the CAPE just wasn't right, man. It wasn't. And in terms of future projections, it's very interesting. And no one expected that. Crazy. Jeremy Siegel maybe, but other than that, no one really did. Anyway, so what we're going to do is we're going to look at this Med Faber thing, and we see Crespont Research, Ed Easterling. And I don't know. You don't know. No one knows. And we're going to see rolling 10-year stock market returns. So our rolling 10 years. Now we see an average of 10% before transaction cost. All right. So you can see it down here, then went up, then it went down, then up, and then down, then up. And you can notice very rarely is it at that average. One time there, right in there, a couple times there, that's it. Very rarely is it at the average. It's either way above or far below. Isn't that interesting? I think so. So if you're averaging 10-year on a linear basis, that you're just wrong. And this is where these guys, like I did a video the other day about some guy talking about taking Social Security early. I said his issue that he's making a mistake is he thinks he's going to get this average rate of return. But you're not going to get the average rate of return. It's going to go zoop, 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 like I said, like an AC current. All right, so let's keep going down here because I want to show you something here. This is what is incredibly interesting. So remember, we talked about John Bogle, the way he evaluates, he's RIP for many years now, but the way he evaluated future returns. You got dividend yield plus earnings growth, plus or minus PE contraction or expansion. Dividend yield, very simple. Right now it's about 1.5. Earnings growth to be determined, plus or minus PE contraction or expansion. That's it, man. PE contraction or expansion is just how much someone is willing to pay for a dollar of earnings. All right, so if you're willing to pay 30 for a dollar of earnings and the PE ratio right now is 25 in the broad market, there will be PE expansion. If you're only willing to pay 20 for a dollar of earnings and the PE ratio is 20, the 25 right now, there will be a contraction. And you can see, look at how much PE ratio expansion or contraction matters. So right here is a dividend yield. You can see it's been lessened, right? And the reason is a lot of stock buybacks, especially in the last 20 or 25 years or so. The dividend yield is a significant portion of all returns in the 30s. Look at that. We had earnings growth negative, and we had a little bit of PE contraction. Isn't that interesting? Previously, we had PE, not contraction, expansion. Previously, we had PE contraction. Pretty interesting. I don't think these numbers are actually representative of this decade here, but you can see PE contraction. People are not willing to pay a high dollar price for a dollar of earnings. So they're going to say, I won't pay $25 for $1 of earnings. I'll only pay 12. And that is significant PE contraction even though we had positive earnings growth and high dividend yields, that PE contraction really hurt the price of the shares. Then we fast forward, we have PE expansion. Even though the earnings growth is negative, high dividend yield plus high PE expansion, people were willing to pay more for $1 of earnings than they were previously. Even though the earnings growth is negative, the dividend yield more than offset the negative earnings growth in the PE expansion. Fast forward here. All right, we got the same thing. PE, this is the 30s right here, excuse me. This is the 1910s, excuse me. This is the 30s. Massive PE decrease, PE contraction. Interestingly enough, is the earnings growth is still pretty good, is it not? Yeah. And then you got the dividend yield. So look at the dividend yield. It's always positive. One of the reasons I like dividends, always positive. Always positive. So the dividend yield rescued this right here. The dividend yield plus the earnings growth did not offset the PE contraction. And then we had massive PE expansion from the 50s, basically 1946 until about 1970 or so. Then we had massive PE contraction in the 66 through 1982. Then we had massive PE expansion, lower dividend yield, which is concerning. Still earnings growth are just chugging along, 5% out on average, 5% earnings growth. This is 2007, 8, 9, all right? Massive PE contraction, and then you had here, this is where we are right now. Massive PE expansion, low dividend yield and earnings growth, a little bit less than historical norms, but still pretty good nonetheless. Check this out. Gazing at the future, why stocks will be underperforming. This is your PE ratio, and you can see every time the PE ratio is high, the next 10 years is low. PE ratio high, next 10 years is low. PE ratio high, next 10 years is low. Now, PE ratio right here was pretty high, pretty low. I mean, it's pretty, just, you can't argue with earnings, man. Earnings drives everything, and earnings relative to how much one is willing to pay. And right now, we're in 2023 right here. So right here, well, there's Pablo. Okay, well, there he is. What was that? And lastly, we have the 20-year periods ending in 1919, starting 1919 to 2023. We have 105 rolling 20-year periods. And the deciles, that's the 10% of the time, you see, 10, 20, 30, 40, 50, whatnot. The average beginning PE, this is the highest beginning PE, all right, had the average ending PE right here, had the lowest rate of return, all right, the decile average. So if you had the highest PE, you had the lowest return. Highest PE, you had the lowest PE, you had the highest return. Isn't that interesting? I mean, it's like clockwork. High PE, low return. Low PE, high return. And we go back to here. Low PE, high return. High PE, low return. Low PE, high return. High PE, low return. High PE, low return. Low PE right here. We think it would be a high return. Who knows? Low PE, high return. All right. I mean, it's just that simple, man. And we can see right here. So PE based on this S&P 500 on average 10-year real earnings per share. All right. So what I want to show you here is I looked at political calculations, and I just said, what is the PE ratio and the earnings going back to 1920 all the way to 2023 where we are today? I find this interesting. You say, it's boring, Josh. That's fine. So the price of the S&P 500 in 1920 was $8.83. All right, so you could buy the S&P 500, one share of the S&P 500 for $8.83. Let me get a drink of my fizzy, my La Croix. Some people say LaCroix. Not me. I say La Croix. Some people say Patrick Roy, the goaltender for the Colorado Avalanche and the hated Montreal Canadiens. Us French Canadians say Patrick Roy. Top of the morning to you. 17-7 Chiefs against Ravens at half. For the love of the good Lord, can we not have a Chiefs-Lions Super Bowl? Oh, Taylor Swift against Eminem. I don't think I can make it. All right. So anyway, what you see here is you'll see right here. 1920, price was $8.83. Earnings was 92 cents a share for a PE ratio of 960. Now you can see what happened here. The earnings went up less than half, but the price went up more than half, so the PE ratio went up from 9.6 to 13.92. 1930 to 40, on the other hand, the price went down and the earnings went down, so we have a PE ratio of 13.23. Remember, 1937 was a bad year too. I think a lot of people overlooked that. So the decade of the 1930s was quite bad, but you can see, oops, I'm getting in the way. You can see right here, $1.56, the start of the decade for earnings with a price of $21.71, a PE of 13.92. Fast forward a decade, our earnings went down pretty significantly. The price went down pretty significantly, so we had basically a break even. The price to earnings ratio stayed the same. But now if we look back at but I'm telling you, this is why dividends are so critical. We're going to see the dividends right here. The dividends are the brown. You can see the dividends are still kicking in. So even though the price went down, the dividends were still kicking in, buying you more shares. All right. Now we go to look at this, to 1950. The price only went up by, whatever that is, 25%. The earnings went up a lot, from 93 cents to 234. So the price went up, whatever that is, 40%, was for 35%, something like that. The earnings went up more than doubled. Look at the PE right here. It went from 13,723 to 721. This is after the war, by the way. Look at that. The earnings skyrocketed, the price did not, and so the PE ratio dropped almost in half. Look at that. Watch what happened in the 50s, though. The earnings went up by about $1, but yet the price went up by 300%. The earnings went up by $1. That's about 50%. The price went up by 300%. Look at that. The 50s just freaking tore it up, man. So you had a PE ratio went from 7 to 17. Isn't that crazy? From 1960 to 1970, we had earnings went up from 339 to 573. Price went from 58 to 90. We had a PE ratio, so the earnings went up a little bit more than the price did, so we had a PE ratio of 15. So again, this just means right here, when the PE ratio jumps that much, that means simply we had a huge price blowout relative to earnings. The prices went up significantly. Here, because the PE ratio went down, even though the price went up, the earnings went up more than the price increase, right? Which means we had a PE contraction, essentially. People were saying, I don't want to buy your shares. Even though the earnings went up from 339 to 573, the price only went up by 58 to 90. And I don't know the exact percentages there. I could figure it out, but I don't feel like, well, maybe I will. So we got 339, 5.73 minus 3.39 equals 2.30 divided by 3.39. So the earnings went up by 69%. The price then went from 90.31 minus 58.03. Oops, 58.03 divided by 58.03 by 55%. So the earnings went up by 15% more. Top of the morning to you. Than the price did. So the PE went down. Earnings went up more than the price. PE goes down. Watch what happens in the 1980s. Earnings almost tripled in the 1970s. Yet the price only went up by 20. That's about 25% increase in price, but the earnings almost tripled. It went from 573 to 15. And yet the price only went up by that. A huge decline in PE ratio. The price went up, but the earnings just blew it out. Same kind of thing that happened here. The price went up, but the earnings blew it out. So 1940, 1950, 1970, 1980. So when is the best time to buy? You bought in 1950, you are freaking in hog heaven. You bought in 1980, you're in freaking hog heaven. Because the earnings went up and the price just went up a little bit. Look at that. Kaboom. In 1920, you're in hog heaven for the next year or so. I mean, next 10 years. 1980, watch what happens here to 1990. Earnings go from 15 to 22. Price goes up again 300%. Earnings go up about 50%. Price goes up 300%. Look at that. PE ratio doubles. Oh my goodness, same thing. Earnings goes up here about a half, about 100%. Price goes from 340 to 1425. So we go from 739 to 1512 to 2904. The PE ratio contracted like a freaking mofo. I mean, not contracted, expanded like a mofo because the price was going up and the earnings weren't keeping track. That means someone right here, starting this decade, in 1980, someone says, I'm only going to pay $1 for $7.39 of a corporation's earnings. 20 years later, I'm willing to pay $29. This is the S&P 500 for corporations, $1 of corporations' earnings. Now you fast forward to 2010, earnings go up, not much, $5 a share. Price goes down, PE ratio contracts. 2020, earnings more than double, price more than doubles, and you can see a little bit more. The price grew more than the earnings. So we got a PE ratio of 24, and then right now, earnings have gone up quite a bit, price has gone up a little bit, and we're right back to 24. So you can see what's happening here. Again, let me just show you. Oops, let me put this over here. Let me draw this out. Because I tell you, man, this is important. No one knows what the future holds, I will grant you, but we do know when the earnings are high and the price is low, so we got earnings going up like this, that's E, price going up like that, that makes PE ratios lower. All right, that's what we want to see for the future. On the other hand, we have price going up like this, earnings going up like that, PE ratios higher. When PE ratios are lower, that has better opportunity for the future. When PE ratios are higher, that has worse opportunity for the future, as we can see in this chart right here. It's all based on earnings, right? 1 second. Right there. PE ratio is high, and right now the average PE ratio is 24. Now we can say, oh, but they don't use dividends as much. They do stock buybacks. Well, stock buybacks certainly haven't kept the earnings from freaking expanding more than the price. In fact, you'd think with stock buybacks, because they're reducing the number of shares outstanding, that would increase the EPS. It does, but it's increasing, again, the EPS by this, where the price is going like that. Now, we can make an argument. The reason for that is because the bonds are so low. For the last 20 years, bond yields have dropped from 6 to freaking 2. Now it's back up to 4 for the 10-year Treasury. But that makes even that much more of an argument that stocks are probably going to not give you great returns. Why? Because the bond prices are higher now. The bond yields are higher now. And the PE ratio is still well above average. That doesn't mean you're not going to make any money in stocks. That doesn't mean you should not add to your stocks. I'm not saying that at all. I'm talking for retirement. Retirement planning, you're not likely to get the same returns as you did if you're just accumulating because you're pulling money out. Again, unlike that guy with the Social Security thing. The stock market doesn't go like this. It doesn't. So even if you average 10% a year or 7% a year, I don't care. You're not getting that every single year. You're getting this. Literally, very few times are you getting even within spitting distance of the averages. Very few times. I'm not trying to make you scared, make you bear market. I'm not. I don't know. I'm still putting money in I put $1,000 every 2 weeks into VTI. But I'm not pulling money out. If you're pulling money out and you're just thinking, I can get 10%, you're just freaking nuts, dude. You're nuts. Just, once again, look. I shouldn't have to tell you this. Right here, here's the average. When is it ever close to the average? Never! On any given year, never! All right, love your thoughts. God bless. I'm going to go back and watch the Chiefs. Let's take a look. Oh, man, for the love. Oh, my wife is calling. Everybody wants me. The dogs want me. My wife wants me. When I start doing a video, let's take a look. I'm predicting that the Ravens are winning again because they had a bad first half against the Texans. I can't believe you like sports. I like sports. Sue me. The Ravens got the ball at Kansas City, 47, down by 10 still, 4-11 in the third. Second and 15, who must have had a false start. Anyway. All right, God bless. Love your thoughts. You heard it here first. You know it's going to be the Lions and the Chiefs. Oh. Oh, I'd have to go for the Lions. At least, Lions got 4 white guys on defense, man. And so, when's the last time we had a Super Bowl with 4 white guys on defense? Probably the Giants when they got slaughtered by the Ravens. That was when the Ravens had Ray Lewis and I think Terrell Suggs back then and whatnot. They were just so good, man. And I'll never forget the Giants. They took the ball. They had Kerry Collins as a quarterback. They took the ball. Why would you take the ball against the Ravens? They went 3 and out. They didn't move the ball at all. And I was just like, what? Oh, it's so frustrating. And so, the Jason Sehorn, the last white cornerback. Oh, you're racist. No, dude. I freaking used to love me some black quarterbacks. I actually still do. I got no qualm with black quarterbacks. I love me some C.J. Stroud. I like the guy up in Green Bay. But the facts are, there are very few whites in the defense anymore. I don't think there's been a white cornerback since Jason Sehorn. So go with that, you know what I'm saying? But I still like football. I'll enjoy it. I don't care. Sue me. Say, oh, but the football, so I get it. They're going to do the black national anthem. That doesn't bother me. I don't care. They got idiots, performing halftime shows. I don't care. I don't watch any of that crap. It's stupid. They're big 57 flavor sponsors. It's stupid. I don't care. I like football. Always have. Is why I follow some old NFL football pages on Facebook. They just had one today with A.J. Dewey, remember with the Dolphins. They hated Dolphins because I was a Patriots fan, and they're all in the AFC East. He had 3 interceptions in the AFC Championship when the year that Marino went and played the 49ers in the Super Bowl. And they're all just muddy and it was great. Football back then was great. Can you believe they actually put turf on the Orange Bowl? I've always wondered, why I don't think the Cleveland Browns ever had turf, did they, when they played in Cleveland? Why did the Broncos never have turf? I don't think the Cleveland Browns did, yet the Bengals did. But there's some teams that never had Green Bay. I don't think they ever had turf. It's just weird. How come some teams always had grass? The Broncos, the Falcons, they played Atlanta Stadium down here, Atlanta Fulton County Stadium. They never had turf. It's just weird, man. Why did some teams stay true to the sport of football and the aesthetics and also, protecting their players' needs without going on turf? I hated AstroTurf. Watching those old games, that freaking puke green field, like at Three Rivers or a Riverfront Stadium, a Three River Stadium. Oh, horrible. Like when Franco Harris picked up the immaculate reception off the turf and took it for a touchdown that should have been called back against the Raiders. That turf just so ugly. Can you imagine being a football player on that? Ugh, horrible. All right. Love to hear your thoughts. God bless. We'll see you.